Hi guys, welcome back to the Pi Podcast. I am your host Irene. Thank you so much for joining us today. As usual, if you do like the content that we're putting out, please share, like, subscribe, invite a friend and a friend of a friend. So today we're going to talk about how do I get started with investing. And this is very useful for people who've never invested before, for beginner investors, and for people who just want perhaps a refresh or a recap and a few more insights, I guess, into the investment process. I want us to think about stock market investing the same way that we think about property investing, because actually they're two different asset classes, but the process is fairly similar. So the only difference that we have here is the fact that if you're investing in a property, say for example, you buy a house and you're paying that through a mortgage, you're essentially taking on debt from the bank and you pay that debt back slowly by slowly. And so most people seem to be very comfortable with that. Actually, we're very proud to say that, yes, we own property. And I want us to feel fairly comfortable as well when it comes to investing. I know there's always a caveat that's put to say that, yes, your assets, you could lose your money, your assets could go up and go down. There's no guarantee of anything. And that's the exact same thing with property. Your property value can go up and your property value can go down. With investing, your stock market investments can go up in value or they can go down in value. I guess what makes it more conspicuous is the fact that when you're invested in the stock market, assets are priced daily. So because you're getting a daily price and you're observing that change, it's more likely to give you anxiety if you don't really know what you're doing or if you don't fully understand the stock market. With property, you purchase the property and you don't tend to revalue a property until, say, perhaps you've remodeled it or you're thinking about selling, or perhaps you're just weighing your options in terms of maybe diversifying your portfolio to see how much the value is now and how much you can afford to perhaps pull out of that as equity to invest in a different property. And because there's such a huge gap in terms of the valuation of property in general, there tends to be more comfort around that because you don't see the ups and the downs. You don't see the periods where the pricing is fairly stable and flat for, a while. And I guess that ambiguity does a lot for people in terms of keeping them calm in that process. The thing I'll say about stock market investing is that you don't want to look at your assets every single day, because there's days where the price is going to go significantly down and there's days where the price is going to go so much higher. And that volatility, that fluctuation in pricing is what makes people very nervous because you think you're going to lose. So the strategy I'd employ us to take on is perhaps have a long-term strategy, a long-term approach. You're thinking of investing for a minimum of 5 years. And if you don't want to invest for a minimum of 5 years, there's different types of investments that you can take part in. Perhaps if you think about your bonds, maybe short-term bonds for 6 months, 3 months, 18 months, 2 years. And if you're thinking about more long-term investing, which is an average of 5-10 years and onwards, then I would say stock market investing is definitely something that you should consider. So you are fairly new to this and you don't even know where to start. Now, the good thing with the evolution of technology is that we have what we call Robo Advisors. And Robo Advisors are essentially digital tools that are powered by some sort of algorithms in the background. And these algorithms essentially assess your individual situation and then make recommendations in terms of what you should invest in. So with a Robo Advisor, what happens is you log into the platform, get yourself signed up and registered and verified, and then the Robo Advisor is going to ask you a series of questions. So some of the questions the Robo Advisor will ask are to do with your age, and this is going to determine the amount of risk that they're going to put in your portfolio and the amount of allocation that you have across different asset classes. And they're then going to ask about your risk appetite. Are you somebody who's open to, high risk? Do you want medium risk? Do you want low risk? And again, it's going to ask about your investment strategy, the duration you want to invest for, whether it's short term, long term, 5 years, 10 years, 12 years, and so on and so forth. And based on the question that it asks you and the response that you give, it will then recommend a suite of investments that will be suitable for you. So to save ourselves time, if you're somebody who doesn't know what you're doing, the best thing for you to do is not get involved in investing in individual stocks, because that is time consuming, and unless you're somebody who's planning to spend quite a bit of time analyzing each and every single stock and understanding the market and looking at all the macro and microeconomic activity that's happening and reading the financial statements of companies and following through their meetings and their future plans, then it makes sense for you to invest in an index fund. With index funds, you're essentially tracking the underlying index. So if you don't know what an index is, I'll use the example of, say, the FTSE 100, which is a representation of the top 100 companies in the UK, and that is why we call it the FTSE 100. You've also had of the S&P 500, which is a representation of the top 500 companies in the US, and so on and so forth. So if you did invest in the FTSE 100 tracker, then you're getting a share of every single company within that tracker. And it's what we call a passive style of investing. So you're very hands off with it. You're going to put your money in a FTSE 100 tracker, and your investment is essentially going to perform based on the performance of the FTSE 100. When it comes to index investing, you could invest in two types of indices. You could invest in what we call a ETF index fund, or you could invest in a mutual fund. The difference between these two is that the mutual fund is traded less often in a day. So perhaps it might be traded at the end of the day. And if you do want to make any changes, you have to wait for a specific point in time when they're going to carry out trades on that day, and then your trades will be made. In developing countries, developing markets, I've seen that a lot of the index funds tend to be mutual funds, and I believe that's because the markets are not very mature, so the level of trading activity is not as high in those markets, and therefore if you're investing in one of those markets, then a mutual fund is absolutely fine for you to invest in. And I guess even outside of that market, a mutual fund is okay to invest in. It just depends on what you're looking for. The other type of the index fund is what we call the ETF, which is an exchange traded fund. And this is a good fund to invest in because, and it's actually quite popular because of the level of activity when it comes to trading. So you can trade instantaneously at different points in the day. You could trade all day on this ETF. And so if you want to make decisions fairly quickly, if you want that flexibility, if you want to react to market news and so on and so forth, that's a good sort of tracker to be invested in. And that's one that's very popular among many investors. And the other thing that you want to think about when you're investing in, well, I'd say tracker funds versus investing in individual companies is thinking about the cost, because the cost of those funds is going to be a factor that ties into the investment return that you do get. So even when I'm talking about Robo Advisors, they do come at a cost. There is a fee attached to them. On average, we tend to see this being around 0.25 to 0.751%. So it's best for you to actually assess all the different platforms that are out there, understand what the fees are, understand what value you're getting from the platform that you're choosing to invest with. And for those individuals who want to invest in individual companies, then you also have to think about the cost of that continuous trading, what it's costing you to place that investment in each and every single company versus investing in an index fund. There are lots of benefits in terms of the cost effectiveness of investing in an index fund. And those are some of the things that you should look at when you're considering the investment returns that you do want. So we've talked about the index tracker funds. We've talked about investing in individual companies and you having to understand the financials around that. So when we come to the index funds, and this is another question that the Robo Advisor platform is going to ask you, is whether you want to invest passively or whether you want to invest actively. So these two different styles of investments have very different strategies, and they also have fees attached to them. And so if you're somebody who wants to invest again in an active fund, as it says, it's active, which means the managers are constantly reviewing it. They're making decisions on a more regular basis. And so for their time, for their effort, for their expertise, it's going to demand a higher fee on that account. If you're somebody who wants a more passive investment style where it's just tracking the index, then the fees associated with that are much lower because not a lot of work is required there. It's just a case of tracking an index, and however the index performs is what's allocated to your portfolio based on the amount that you have invested. So the other point that I would like to make is why these robo-advisor platforms are really good for new investors is because you can invest usually small amounts of money. So you can start from anything as low as zero. Some of them do have a minimum like £500, but it's amounts that are reachable to many people. So depending again on the jurisdiction that you're in, you want to maybe have a look at the different platforms and look at what you can afford to invest on a regular basis and then go with that platform. Now that we understand that and we understand the different types of investments that we can make, whether it's you're investing in an active style or a passive style, whether it's DIY investing, which is where you go and invest in stocks on your own, do the analysis, and so on and so forth, we can now proceed to the next step where you can think about perhaps what sort of industries you want to invest in. So if you're somebody who's tracking say like the FTSE 100, there are different type of ETF funds out there that track specific industries. So we do have what is called the GICS industry classification, and this tracks like a series of industries from financials to consumer staples to technology to communication. There is a whole plethora of them. And if you're somebody who has particular interest in any of these industries and you feel that you don't want to do a tracker that's particularly tracking the whole FTSE, then you can go for ETF funds, which are more specialized and they track a specific industry, which if that's what you would like to do. So you have to think about whether you want to be an investor who's investing for income or investing for capital gains, or investing for both, because depending on the type of industry you're investing in through that particular type of ETF, it's then going to determine what is available to you. So if you look at perhaps the tech companies, if you want to invest in a tracker that's following the tech stocks, then you might not always get dividends because then they're generally not dividend paying industries. They're more about capital growth and capital appreciation. And if you're somebody who wants to get dividends, you might want to look at industries that are more consumer staples, and they're sort of like dividend aristocrats. And they tend to be fairly boring companies that have been existing for a very long time. They're very agile, able to adapt to, the changes in demand, the changes in the market. And then they have consistent dividends, which is something that you also want to look out for if you're somebody who wants to be in that category. So once you've understood all these things, then I'm going to talk a little bit about your risk appetite to help you select a risk appetite when you're in the platform. Risk is generally graded from 1 to 10, with 1 being the lowest risk and 10 being the highest risk. Now, if you're somebody who is high risk, it means that, for example, you're very happy to be invested in a tracker that's following only tech companies, because tech companies tend to have quite significant growth, as we've observed over the years. And so you would be somebody who's got like a higher risk tolerance, and perhaps you might be open to investments with a risk tolerance of about maybe perhaps above 5 towards 8 and 10. If you're somebody who is more conservative and you want that bit of balance, you might be sitting bang in the middle, which is 5. So you do get a good share of your equities and you also get a good share of your bonds. If you're somebody who's more lower risk, then you're potentially looking at 5 and below. And so I want you to translate that sort of risk framework to any type of risk assessment that you're given on the platform. Some of them will grade it from 1 to 10, some of them will grade it from 1 to 5, some of them will grade it from low, medium, high. So just adapt that to whatever platform you're using and then that should benefit you. The other thing that you might find is that there's what we call the asset allocation. And once you selected that risk appetite, then perhaps it says to you, oh, your risk appetite, based on the questions and the answers that you've given, we're placing you at a risk appetite of 5. And then you proceed to look at the index funds that they're suggesting for you to invest in, and you find that it's heavily geared towards perhaps equities. I wouldn't be too concerned about this because they've made an assessment based on your inputs. They've also made an assessment based on your age. Younger people up to 40 years old tend to be encouraged to invest in what we call equities, which are higher risk, because you have that flexibility, you have time on your side, and you can definitely afford to, place your investments or your invest in assets that are a bit more risky, because on average, you want the investment to do well, but should it not do well, you have time to recover any of those losses. For individuals who are perhaps 40 and above, what the investors will do is they'll begin to put you on a sliding scale, which means that you start moving out of equities and you're shifting more towards bonds and trying to have that balance in your portfolio, because at that age, the time that you have is a lot less than you had initially. And so security is really important. So you don't want to be too heavily invested in equities, because that volatility is perhaps not the best to have in your portfolio at that age. And as you approach retirement, they're getting you even closer to less of equities and more perhaps bonds and less riskier investments. So let's talk about some of the language that you might find comes into play when you're investing in some of these platforms, the terminology that you might see hovering around. So the first thing is diversification, which is a good, one of the benefits of having an index fund is because your assets are diversified across every single company in that particular index. And so diversification just means that you're investing in different industries, like we've talked about the GICS industries. We've also talked about perhaps you're investing in tech companies or, consumer staples. You're investing in financial services and banks. And that just diversifies your portfolio, which means that you're not susceptible to risk for a particular industry. The other bit of terminology that you might see is rebalancing. So if you do see rebalancing, this basically means that there's an assessment that's been done overall, and we want to understand what you want, what type of assets you want in your portfolio and in what percentages. So if you have, say, for example, a portfolio that has equities and that has bonds and that has cash and also has real estate in it, then what this rebalancing process is going to look at is it's going to assess what quantities your portfolio requires in what percentages, and it's going to make sure that as the tracker is evolving over time, that you're essentially still within the sort of balance that you require. And if that needs to be changed, for example, say equities have performed highly over a certain period and your equity allocation was only 50% and now it's moving to 60%, the manager is then going to go and sell 10% of those equities and reinvest them in the asset that needs to be pushed up to ensure that you maintain that balance on your portfolio. You could have a couple of options in terms of whether you want your portfolio rebalanced on a monthly basis or whether you want it rebalanced on an annual basis. I'd say as a beginner, because you're following a tracker, I'd say rebalancing on an annual basis is sufficient. However, rebalancing more frequently tends to be better suited to individuals who have a larger portfolio or who have significant value of stocks and shares in their portfolio. So in summary, I'm going to say open the account, set your goals, choose your risk level, and invest your first £100 or whatever currency that you have, and begin to learn about the process, see how it goes. And the more you do it, the more comfortable you get with it, the more of a pro you become with it, and the better you become at managing your finances and building that generational wealth. Thank you so much for joining us today. I will see you next time. Bye for now.